Good afternoon, everybody. Thanks for being here. I'm Walt Rogers. I'm the Deputy Director of TEF Iowa, Tax Education Foundation of Iowa. We seek to provide policy solutions that benefit all Iowans. This afternoon, we are releasing the economic impact of COVID-19 on the Iowa economy, a first cut. The first in a series of reports that examines the financial implications of the virus, authored by Dr. Ernie Goss and Mr. Scott Strain. The first report is based on a brief snapshot of the data currently available from the early days of the virus in Iowa. The picture will become even more clear after April data is released later on this month. We can already see that COVID-19 is impacting our state's economy in an incredible way, both in terms of wages and jobs lost to Iowans on future government budgets. So it's important that we take a deep dive into the economic realities of the pandemic. For instance, this first cut will reveal projections of a total cost to the Iowa economy so far, as well as projections about lost tax revenue. TEF Iowa is proud to have these two noted economists, Dr. Ernie Goss and Mr. Scott Strain, join us to discuss the findings of their first cut. Before I turn it over to the economists, I want to let you know that if you have questions, submit them in the Q&A section. Dr. Goss and Mr. Strain will give a summary of the report. They'll go through it, and we'll take questions at the end. This whole briefing should last about 45 minutes. So, Dr. Goss, I turn it over to you.
Thank you, Walt, and thanks to TEF Iowa, you and John Hendrickson and Dan, all your great people at TEF Iowa. Thank you for that. Thank you for bringing us on. First, I'll just say that this is a first cut. Now, why a first cut? Because we're really limited in data right now. We're going to do a second cut and a third cut when we get better and better data. But we're living in a world which is, we're talking about not monthly. We're talking about weekly and even daily impacts that are changing as I speak. Why a first cut? Well, the BLS, as I said, BLS employment data for the month of April will not come out till May the 22nd. So we have to do something else to get better data. And we use the weekly claims for unemployment insurance, which we'll see shortly. But the impacts to Iowa really didn't happen. If we can bring up the first-time claims for unemployment insurance, a slide showing those first-time claims, and you'll see that. I mean, what's those numbers? We're seeing in Iowa, the real impacts came in the 21st, the weekend, and now that's a Thursday. A week, the 21st, about 41,000, then it jumped up to 56,000, then up to 64,000, and then 44,000. Now, importantly, and I can't see that last, the 18th, but nonetheless, the first-time claims have come down. Let me see if I can move that aside. So I can, and the last number is the 28,000, and remember, these are first-time claims. What we really need to watch is the continuing claims, which now, if we can bring up that slide showing continuing claims, look at that. I mean, these are individuals that are continuing to draw unemployment insurance. They have been laid off or otherwise disconnected to their companies they were there, and you see that they began to rise again around. We're talking about continuing claims. On the 21st, we only had 22,000. And then in Iowa, we're up to, on the 28th, we're up to 54,000, then 127,000, 152,000, the latest number. Now the 18th is out. Those aren't here available yet. Not final numbers. Those are preliminary. And the preliminary numbers would say 170,000 for the 18th, 171,000. Now, here's a very important point. These are just those who are drawing unemployment insurance. In Iowa, about 40 to 50% of the unemployed workers draw unemployment insurance. So you can almost double this. So you're up to 300,000 there, the last number on the 11th. And you look at the 18th, you're probably up to 340,000 unemployed workers in Iowa. And certainly this is, and I'll let, and Scott will talk about more of the methodology, but I think a lot of folks are saying, is this going to be a V-shaped recovery. That's what I initially, when I was on radio interviews talking about, a V-shaped recovery, meaning sharp down, sharp up. Then I moved to a U-shaped, sharp down, move along the bottom, then sharp up. Well, I've changed that to a Nike swoosh or a check mark, meaning sharp down and a gradual increase. We're just not seeing the return, even in states that have sort of opened back up. Georgia, for example, you're not seeing that. We're not seeing a sharp upturn. We won't see that. Even the CARES Act, even with the trillions of dollars the Federal Reserve is putting into the economy, and the Fed, the U.S. Treasury is putting into the economy, we're talking about a deficit this year that ultimately may run between $4 and $5 trillion. Now that's on a U.S. economy that's 22 trillion. So you get an idea about the devastation. Economic devastation, I'd say, but it is recoverable. We will recover this. We will get back to business. It's just, it's going to take a little longer than we initially thought, than I initially thought, and certainly it's troubling. But this is I guess unfortunately or fortunately, we're all in this together. It's a global economic downturn, but the negative side of that is you can't look to other nations to bring you out via exports. We're in this for a deep downturn. It's the largest, I will say right now, go on record as saying this is the largest downturn in GDP when it's all at the end of in this period of time. If you annualize it, it's the largest downturn that the U.S. economy has experienced since we began recording GDP in 1929. And as all the viewers know, 1929 was the beginning of the U.S. Great Depression. So if we can bring up the next slide, and we'll talk about some of the other, the insured and the unemployment, the insured unemployment rate. Again, we're up to the 18th, brings it up to 10.5. Now, I wouldn't argue for doubling that to get the real unemployment rate, but it's certainly, we're in the neighborhood. We provide a measure of that in our study, but in Iowa, we're probably at 15 to 16%. It could be even higher. Again, we won't know the number until May the 22nd for April. We're probably, again, 15 to 16%. And I think I may be on the low end there. Scott can chime in on that. But we're talking about the highest rates of unemployment that we've experienced in many, many, many decades. And if we can bring up the next slide there, please. And there you see where the rankings of the insured unemployment rates, and you see Iowa's almost in the middle of the pack, with Michigan at the highest insured unemployment rate. And a lot of that has to do with, in Michigan, you're talking about durable goods manufacturing, automobiles and parts manufacturing, workers that have been laid off by either Ford, GM, or others, and they are drawing unemployment insurance. And I'm sure we'll talk about the Fed, some of the programs that the federal government and the Federal Reserve have implemented, if we can bring up that next slide. And Scott, if you want to jump in here and talk about the methodology that we used and measuring that. And you see well, I'll let you know it better than I, Scott.
Thanks, Ernie. We looked at the continuing claims, the net incremental increase in claims for the period March 21st to April 1st, and used that as the foundation to make our estimate of what the downturn means to the state of Iowa. We found that during the last recession, the recipiency rate in the state of Iowa was about 40 to 41%. These are the people that are unemployed, part of a state program relative to the total number of unemployed reported by the Bureau of Labor Statistics. Using that as the bridge, we were able to move from continuing claims to a rough estimate of the total number of unemployed in the state. And then we took that information, distributed across industries based on available information at the national level, as well as available information at regional and state levels, and took those figures, put them into a software program called IMPLAN, which is one of the most widely used input, excuse me, regional input-output models available. And from that, we were able to come up with an estimate of about 243,000 jobs lost in the state of Iowa for the March 21st to April 11th period. About $500 million in wages, this is salary, wages and salaries for employees lost, and then self-employment income took about a $74 million hit. The total impact to the state of Iowa comes in at about $1.6 billion for this time period, and that is a figure that tracks sales at each level of production. So 1.6 billion represents the impact to the output of the state of Iowa.
And Scott, I don't mean to interrupt, but you came up with a GDP estimate if this continues on.
That's correct. If we annualize this impact, if this impact were to continue for a 12-month period, you're looking at about 9 to 10% of the gross domestic product for the state of Iowa.
Lost,
yes. Go ahead and go to the next slide. Thank you. We took a look at what's the fiscal impact, and you can see that sales tax receipts during this period likely took about a $38 million hit. What we anticipate is when it comes time for individual income taxes to be paid, you're probably looking at about $27 million. And then in total, the fiscal downdraft hit Iowa to the tune of about $112 million to state and local tax coffers.
Can I reiterate something here? Because as a former state representative, I'm looking at $112 million. So, you know, that's not that much, but then that's only a 3-week period, correct?
Correct.
So when you look at it like that, that is a huge amount of loss.
Not only that, Walt, the impacts are growing. And I want to explain here, someone might ask about the property taxes. How could it hit on property taxes? Well, that's an opportunity cost. In other words, this is property that would have been built and taxed, that the taxes on that, but also the assumption that you'll get the assessments will come down. Now that's a pretty big assumption there. The problem is if you don't get those assessments coming down, you're going to put a big time hit on some of the businesses and farmers out there, of course. And by the way, my picture there is of Iowa. It's a picture of a farm near Glenwood, Iowa. A friend of mine has that farm, and his son took the picture, and I love it. So I'm using it. I did pay for that. I didn't pay for a royalty on the Nike swoosh though. So that was don't turn me into I've forgotten his name now of Nike fame. But anyway, he would send me a bill for using that swoosh.
Now that you say that, I had a reporter from up here in Northeast Iowa who wanted to get on our press briefing, but he couldn't. And he said that you were on his show a month or so ago and had a pretty, pretty good outlook at that time. And I think that's when you were talking about the V.
That's right. And that must be Jeff Stein.
Yeah.
I've actually been in his studios. I always love talking to Jeff. He has wonderful questions, and that's a great one right there. It was. I thought it was a V-shaped recovery. I did not know that we would have this shelter in place across America. I didn't expect it to be shelter in place. I didn't expect it to last this long. I saw the stimulus. We knew what CARES was. It was a $2 to $3 trillion federal support. Then you had the Federal Reserve buying up bonds to bring down long-term interest rates. You had the Federal Reserve stimulating the economy through other means. So it was clear we've never seen a downturn like this, but we've never seen a reaction this quick and this big. It was that big. Unfortunately, the shelter in place is remaining. Now, I can't comment on the medical part. I see the deaths rising, but what about, and I don't know this, but many medical folks talk about the deaths that are because of shelter in place, the deaths that are coming about because of individuals not going to their local physician, to their local hospital to do colonoscopies, to do what's sometimes called elective surgery. Some of it's not that elective, and some of those. So we're not seeing that recovery, and the shelter in place is really hitting some states more than others. I would argue that Iowa is taking a more, in my judgment, more sensible approach to opening up. And we've got, if we don't get back to opening this economy, I heard there was a Harvard study came out and said we'll need to shelter in place until 2022. There will be nothing to come back to. That is a nutty proposal. I don't know the economists that did it, but we need to have their license taken, and we don't even have a license for economists. So, but if we did, we need to issue it and take it back. That's a crazy idea.
I think we've moved into some of the question and answer period. One that's top of my list here is how quickly do you actually expect unemployment to rebound?
You mean turn down? You mean
turn down? Yeah.
Scott, you want to jump in on that?
Well, I think you're gonna have to have supply chains recouple. You'll need to have retail open, have a rebound in the energy, because the energy sectors where we had the most significant capital investments, I can see that taking 12 months, 18 months.
And I think another thing, if I may, Scott, the federal government the CARES Act is not that supportive of bringing back workers. In other words, there's 4 months of, if you can get $600 plus your normal unemployment insurance, and there are 4 senators that voted against that. There should have been more senators that voted against that portion of the bill, and that is very hurtful. So my belief is, my expectation, I probably should say, is after 4 months we may see some declines, but it's not going to be what we need to see. After that period of time when individuals they lose the $600 and say, well, I'd be better back off at work. So we'll see a return there. And the real problem with the CARES Act, and to some degree the Federal Reserve's actions, is too much politics in there and not enough economics. So, but I would expect the rate to come down a bit in 4 months, then in the third and fourth quarter come down a bit more. But as Scott said, it's going to be a longer recovery than the president's indicating. I think it's going to take some time, particularly in the energy sector, as Scott said. That would be more in North Dakota. That's the survey state of Creighton's that I do surveys on. And of course, Iowa's energy. What about ethanol? Iowa's the #1 ethanol producer in America. It's being hit hard now, but not necessarily just by COVID-19, but also by the nonsense of Russia, what Russia and Saudi Arabia, that battle they got into. What a battle.
Yeah. This question is, speculative, but you guys would be the best ones to answer.
Sometimes we're called soothsayers,
What do you expect legislatures to do in these next year as far as budgets when they see these revenues decline? What do you expect them to do? I'm thinking about both Nebraska and Iowa.
Well, unfortunately, there's going to be a temptation and a push to raise taxes. I would like to see more and more. I would support more fees instead of taxes. Fees normally don't discourage economic activity like taxes do. We're seeing the Iowa casinos now have been closed down, and who knows when they'll be opening back up. They had, of course, in August approved sports betting in Iowa casinos. That there's lots of revenue there that goes to the local, ends up at the local area and the state area. We need to see the casinos open back up in terms of raising taxes, but there's going to be pressure to raise income taxes, should be. I think in those cases when you can issue debt, when you can issue debt, now is a wonderful time to issue municipal debt, to issue state debt. Now, Iowa's state debt is good. There's some states when, do you want to buy an Illinois bond? Probably not. And I hear you talking about two states right there together. They're not the same fiscally. They're not the same. And Iowa's a better bet there going forward. So issuing debt instruments would be a good thing. On the regulatory environment, we do need to see more movement toward reducing some of the onerous regulations out there. And there are many in Iowa and other states that could be cut. Scott, you probably have some better suggestions than me, though.
Well, no, I was thinking of the regulatory environment. The other thing, there might be a push to raise taxes. There might also be a call for cutting spending, austerity. This is a random perturbation, and it's going to be temporary, even though it might take us some time to work out of it. I don't think the legislatures across the nation need to take draconian measures. I think once the economy starts moving again and you start refilling the coffers, we won't make up all that was lost, but we'll make up a fair portion of it.
And one thing, if there, the positives to come out of this is we're doing this online. I'm teaching my classes online. We have universities doing classes online, mine included. A state K through 12 delivering classes online. We need to see more of that on a hybrid. I'm not talking about continuing to deliver all the classes online. I'm talking about a hybrid solutions. That's going to be wonderful. In other words, we in education, we're the last to innovate. I'm sorry to say. We need to see more innovation there so that state and local taxes in terms of support for the K through 12 can be less onerous going forward by providing some of the care, some of the learning through technology. Now, I'm not arguing for staying home. I'm arguing for a hybrid approach. We're going to see that, and that's a great thing to come out of this tragic situation.
We have the same question. It was a great one we had in the press briefing is what are some of the critical macroeconomic measures to keep an eye on? What are the anecdotal evidence that you are paying attention to?
Okay, I'll begin there by saying keep an eye on our two surveys. They're regional, not necessarily U.S., but our Creighton surveys comes out the first business day of manufacturing, almost a record low on the manufacturing. Manufacturing in this case is a lagging indicator, believe it or not. On the bank, we do a survey of bank CEOs, comes out the third Thursday of every month. That one measures impact of agriculture and energy, record low levels. Watch those two surveys. Keep an eye on the 10-year U.S. Treasury bond. That yield measures risk. When everybody's scared, they're moving in and buying the bonds, pushing the price up, the yield down. Yield is at has been at record low levels, 0.6% to 0.7%. You take out inflation, you've got nothing there. You got a negative return. That's how scared we are. Gold to some degree, but it's less of a good measure than the other one. And Scott, you had, and the stock market, I'm saying I think it's still overpriced. Certainly there are some stocks in there that are overpriced. So I wouldn't use the equity markets to see what's going on.
So I'd pay attention to high frequency data, the unemployment claims, financial market information. I would also pay attention to spreads between some of the corporate issues and treasuries, and then some of the commercial paper issues. I'd also look at some of the real estate backed bonds that are out there, especially related to the retail space. Those are all going to give us indications of increased risk as well as improvements in the economy.
And when we say spreads, that's the gap between, say, a high yield corporate bond or a AAA corporate bond and a comparable treasury. So what happens is when risks go up, investors flee the corporate bonds and go into the government bonds, bringing down those yields and raising the corporate bond yields. So that's the spread you were talking about.
Mm-hmm.
Right. Very good. Good question here. What form of additional federal stimulus would likely have the greatest economic impact? Examples are dollars for state and local revenue shortfalls, infrastructure projects, additional loans and grants.
Scott, you want to take it there?
if the federal government needs to do something, probably payroll tax, eliminate the payroll tax for a period of time. The problem that I have with infrastructure spending is by the time any decisions made, the crisis is going to be over. If you recall the last recession, we had all this money that was put out there, almost $1 trillion, with the idea that we'd have all this infrastructure spending for shovel-ready jobs. And we had politicians some period later laughing, oh, well, I guess those shovel-ready jobs really weren't ready.
Well, some politicians, you mean the president? President
Well,
Obama laughed about it. We have some video on that. He laughed about shovel ready. They were not shovel ready. So I think the federal government, in my judgment, is really, I'm not arguing against it. They needed to do what they've done, but maybe, as Scott said, we could have a cut or elimination of the payroll tax for a period of time. But my concern is, we go back to the recession, the last recession, 2008 and 2009. Why did it not do anything? Well, individuals and businesses held on. Their confidence was not to the level where they would invest more, buy more, spend more. So what the federal government can do, and I think it is encourage, incentive, or I should say, bring back confidence. Now that's not going to be easy. And look to these other indicators. And but again, some of the infrastructure, I would argue, is, you're right, Scott, it takes too long to do it. But in terms of broadband access and telephone access, we need to see some of that for rural areas. And I have a home in rural Iowa, and I have pretty good coverage for rural areas, but there are lots of parts of Iowa that are cut off right now and feel cut off and cannot engage and come on. They don't have the bandwidth to watch some of these videos and to take advantage.
Right. Could you go a little deeper into how COVID-19 will affect the manufacturing and the agricultural sectors of Iowa?
Yeah, the manufacturing has been a laggard here, and that's a good thing, meaning it came from the consumption side. That would be in travel and tourism, right? And it spilled over into manufacturing. Our number for March in the manufacturing sector for Iowa was not that bad. It wasn't good. It wasn't that bad. Now it's getting bad. It's lagging. But in terms of overall outlook, you're talking about manufacturing that is we're talking about the most productive manufacturers on the face of the earth. We should not dread or even shy away from competition. We will outcompete everybody, all other nations. So we need trade barriers to come down, and the two senators from Iowa have been out front on that, very important, in getting USMCA signed and getting the phase one with China. Now, some would say that's not a good deal, but I would argue it is. And that was in January. We were all very confident about 2020 for agriculture. Agriculture, obviously, we need higher commodity prices. And we need, of course, a rebound in ethanol with oil prices moving up. And I think we will see that as the economy improves. Oil prices move up, ethanol prospects improve, and that would be very good for Iowa. Agriculture in terms of grain, that would be, of course, corn and soybean in terms of the replacements there. Livestock, we need, again, exports. And we're talking about a cheap dollar that's going to be supportive as well. So I'm very positive long-term about Nebraska's and Iowa's two sectors of agriculture and manufacturing. They can't outcompete us. We will compete as well. Scott, do you want to add anything there?
Well, I think I was encouraged this morning. I believe I saw that the Tyson plant there in Iowa is going to be reopening, I think on a limited basis to begin with, but I found that encouraging also.
Yep.
Or even discouraging if we don't have. Can you imagine the crisis in food if the supply chains were hurt there and the packing plants? There has to be a solution there, and I think there maybe have to be some intervention. Now, the federal government through the requirement that they remain in business. Well, what about the workers? I mean, there has to be some support for being able to keep distances between and among workers. And of course, Tyson and other food producers will find the answer, but it might be a costly answer, and should be some federal support in that area. And I'd argue for support in terms of exports. I would argue in terms of potentially direct support, and I'll leave that to the politicians to figure out how to do that one.
My son owns or started a small business where he grows microgreens here locally. And microgreens are the little sprouts that you clip them at 12 days and you sell them as salad or whatever. And but he's in a place where he doesn't know what's happening, and there's, the next question I've got is about small businesses. And have you seen anything that talks about how small businesses are going to get through this?
No, I mean, it's obviously, and you don't need an economist to tell you this, your son knows his market is dried up. I mean, we're talking about restaurants, and that type of farming, you're more profitable if you're close to a metropolitan or urban area where you can sell directly to the restaurants. And that's very important. I mean, that's an important and growing industry for Nebraska, for Iowa, for other states. I keep using these same states, but we have this all in common: Kansas, North Dakota, and South Dakota. And yeah, the small businesses, restaurants, all of a sudden you're allowed to open in some cases, but you can only have so many tables. Well, that may be an unprofitable level of operation for the restaurant. What about the bars? We've got to look at that, and you'll have to get somebody has more expertise in restaurants than I. But you're talking about hotels. We're talking about business conferencing. We surveyed our manufacturers. They're not doing business conferencing. Who is? I normally do probably 50 presentations a year to business groups, agricultural groups, banking groups. I'm down to 0. I haven't done a presentation in 2 or 3 months, and maybe that's a good thing for those who can. They don't have to listen to my voice, but it's a hit on my income, by the way. And by the way, my income, and I think that's an important point. My income may be down, but there's some of these restaurateurs and hotel owners are down to 0 or close to 0. So those of us who are online right now, we're still making money. These individuals are not making money. And not only that, their costs go on. And replacing it with government money, it's not a solution. We have to move to other solutions other than the government. It's like the father giving his daughter a bailout money and then taxing her, and she gives it back to him, and he gives her another. It does not work. We've got to be able to get the broader economy going. And like your son, he needs the restaurants opened.
Now, the private sector is going to lead us out of this. The private sector will be the solution. That's where the innovations come from. The Zoom folks that came up with the technology we're using right now. Think of the cost savings from the private sector innovation, the cost savings available to state and local governments for reduced travel costs. Think of the conference savings. I mean, that's where
that's going to go on.
Yeah.
Right.
I had a basic economics class in college. I remember the teacher gave an analogy of economics, kind of like a huge freight train. When it's rolling down the track, it's just cruising. But the amount of energy it takes to get to that train to move in the 60 miles an hour is a lot of energy. But once it's there, it's just a cruising machine. What's it gonna take? I mean, number one, is that a correct analogy? And number two, what's the extra amount of energy is it going to take for our economy to get back to a cruising machine like that?
Well, like Scott said, we've got to move to open the economy back up. I'm sorry. I mean, unfortunately, there will be deaths with identified connected to COVID-19. However, there are deaths right now connected to unelected surgery that's not taking place, checkups that are not going on. We're killing, perhaps, I don't have the number, we're killing potentially as many people as we're saving by being sheltered in place. We've got to move to open the economy up. And I think those of us who may be in a high risk group, we may have to be somehow quarantined or sheltered or whatever, but we've got to move. And I realize I may be banned from whatever forever, but that's the way I see it. It's just, we cannot kill, as I put in one of my presentations, I think, killing the goose to save the egg.
Right. Essentially, we just stopped that freight train.
Yeah. Sorry, I should have continued with your analogy there. That's a good analogy, but we did stop it. It's in the, Walt, and the listeners, and certainly Scott knows this, just, and maybe all of you do as well. We haven't had a calamity like this that affects the economy in our history. People say, well, what about 9/11? I'm like, are you kidding me? Not even, it's a pimple on this one. We're talking about we've been keeping GDP numbers, gotten the numbers back to 1929. We saw a 13% decline from 31 to 32. This is it may swamp that one. So are we in for the Great Depression? No, we just have to get back. We can't do what those two Harvard economists said, wait till 2022. Well, maybe we economists can wait to 2022. Maybe we educators can wait till 2022. People in the nuts and bolts of the economy can't wait.
Mm-hmm. Well, as we wrap up, let's wrap up with some hope and positivity, like we did at the end of the press briefing. Both of you give us kind of an idea of what you think is hopeful coming around the bend. I know President Trump has talked about, he's kind of changed his view of things, and he keeps saying, now it's after the fourth quarter. He thinks the fourth quarter will be real good, and next year, obviously, great. He's going to say that, but do you anticipate something like that, or what do you think is going to be hopeful for us?
Well, I'll say the hopeful part. The hopeful part is that this is introducing us to rely more heavily on being more innovative, like with technology in education. It's dragging those of us who are in higher ed or even in K through 12, those solutions that are very dynamic. So it's going to, in that regard, we're not going back, we're going forward, which is a real plus. The second thing is, again, we in America, and particularly in Iowa and in this part of the country, no one can outcompete our manufacturers. No one can outcompete our agriculture. Open it up. We need to, the idea that somehow China or Brazil, for example, Brazil is going to eat no, Brazil is not going to eat our lunch. Well, they may well eat our lunch, because we're going to be shipping food to them, but we'll outcompete them all. So we need some movement toward opening the economy, freer and fair trade, and we will do quite well. Again, I don't expect it to be a rebound. Will it be a V, W, or I think it's going to be more of a check mark or a Nike swoosh? Scott, do you want to?
Well, what I'm thinking about, and this goes back to Walt's analogy, it's going to take us a while to get the boiler heated up, get the steam going, and get the locomotive going again. And again, I think that's going to take at least 2, 3, 4 quarters. But the thing to remember is we didn't suddenly become less productive. We didn't have the type of overhangs or imbalances that we typically have to work through in a recession. This was a voluntary closure of our economy.
Right.
This is a completely different set of circumstances. And I don't think we become less productive. We didn't suddenly lose all the human capital, all the skills that we've accumulated for years. We still have a productive labor force, and just let them get back to work.
That's the way I see it, is that, like Ernie was saying, this country has the element of freedom, and freedom is the engine that spurs all these ideas and all this innovation and all this growth, and that's the steam in the engine that's starting to go quicker and faster, and finally we get to a place where it's just cruising down the track again. So hopefully we'll get there sooner rather than later.
Will do.
Well, I just want to thank both of you, Dr. Goss, Mr. Stain, for being here, Stain. And hey, this has been a really good discussion. We thank you and appreciate you for being here. And once again, this webinar will be on tefiowa.org, tefiowa.org, and we'll be coming back in the next months and weeks and months with cut 2 and cut 3 and looking at the data and seeing what's really happening. And maybe it'll be a V and maybe it'll be just swoosh. We don't know, but we know that Americans are going to fight hard to get back to where we were.
Right. And thanks, Walt, and thanks to your organization. And by the way, I should have said this at the beginning. I go by Ernie. Only my wife and kids call me Dr. Goss. So.
All righty.
Thank you, Walt. Thank you, everybody.
Take care. Thanks so much.
Thanks, Walt. Thanks to TEF Iowa.
Thank you. We'll talk soon.